See, we started the topic capital gains. See, in capital gains, our plan is to study the topic in two parts. Part 1 will be basic conditions and computation, and part 2 is section wise studies. Okay. Now in part 1, in the basic conditions and computation, I have to explain with the help of this flow chart. Okay. And in this flow chart, in this flow, I have finished these two things. What is a capital asset and what is transfer? Okay. Means if you remember, I explained like this: a student has to study when to compute capital gains and how to compute. So when, if these two conditions are satisfied, then to compute capital gains. When? Then. Now, once a capital gains arises, first we have to check it is short term or long term, because accordingly the format will be decided. Because for short term capital gains, the method of computation is different, and for long term capital gains, method of computation is different. So the question is how to decide short and long. So see, generally look, there is a rule: if an asset is sold within 3 years, short term. But if you hold the asset for more than 3 years, and if you sell after 3 years, then it will be long term. But for shares, it is 1 year only. Items like shares, if you sell within 1 year, short. After 1 year, long. But now the question is why? Why there are two capital gains government has made? Why no? Why don't they make one single capital gains? There are two capital gains, short and long. So what is the logic of creating two types of capital gains? And then in that also, for shares the rule is 1 year, and for other asset 3 years. But see, 1 and 3 years is the second thing. Most important thing is why two types of capital gains. One is short, one is long. It could have been like this also, capital gains. But no, some capital gains are short, some are long, and the tax treatment is also different, calculation is also different. But why government has made two sets, short and long? So see, idea of government is what you know. Government wants to discourage short term by punishing it, and they want to encourage long term. And to encourage long term, they have kept long term as separate, and they have made all good provisions so that long term is encouraged. And government wants to discourage short term by making bad provisions, such provision which you will hate it. And if you hate that, you will stop short term. Basically, idea is to discourage short term. But why? Why so hatred for short term? Why government wants to discourage short term? Because see, I'll tell you, with the help of stock market, I can convince you. See, in stock market, have you heard many people, they buy these shares, within 2-3 days they sell it. And you know, these are short term players. And because of short term players, our stock market becomes volatile. What do you mean by volatile? It suddenly goes up, suddenly goes down, anytime it goes up. Stock market I'm talking about. But tell me why our stock market is not stable, why it is volatile? It is because of short term player. Literally these short term traders, they are ruining the stock market. That's why government hates short term. Basically government wants what you know, if everyone does long term investments, means if you invest in shares, if you keep it for a long time, and if you sell after a long time, our stock market will be stable and steadily rising up. But that dream can be achieved when? When everything goes long term. But then people don't understand. That's why government has to make good provisions for long term, so that people get attracted, and bad provisions for short term, so that they stop short term. Anyways, if a person doesn't bother about government, he will do what he want. See, however you punish, if I am so adamant, I will do short time, I will do only. But government is trying its level best to stop short term. Otherwise, practically it is not possible that short-term thing will completely stop. Okay. But see, I gave example of stock market. That in stock market, when people buy and sell within a short period, market becomes volatile. So that is for shares. Same thing can happen for every asset. Imagine for every asset people are doing short term, short term. So just as our stock market is volatile, our Indian economy will become volatile. So these are the bad effects of short term. In short, read what I have written. Government's dream is to stop and discourage short term as much as possible. And to discourage, they have made bad provisions. In the sense, the rate of tax is also high on short term. General short term capital gains is taxed at slab rates. Only that equity share short term has a special rate. Satak G under 111A. But other than equity, other short terms, if you see in that Satak, Latak, Venex balance, it will go in balance column. That means general short term is subject to slab rates. And in slab rates, your tax can go to 30%. But long, always 12.5 after budget. Whether it is equity shares oriented or other Latak G. Remember two Latak Gs, one is equity shares and others. All Latak Gs 12.5%. This itself proves government loves long term because they want to encourage it. See, I have written here encourage. And they hate short term. That is why government has made two separate things. Okay. If government didn't have that different mind in their mentality that short should be treated bad, long should be treated good, then they would not have kept two things. But in their mind, this is going on that short people are bad. We want to discourage. That's why separate working for short and separate working for long. One more thing. Tell me what government expects from people then. Means basically government is expecting that if you buy an asset, hold it for at least 3 years. Don't be so desperate to sell it. At least hold for 3 years. Yes, in stock market we understand it's very difficult to hold the shares for 3 years because every day you can see the prices. So you feel tempted to sell it. So you become greedy. So in shares, government cannot expect you to hold for 3 years. That's why government is acting matured. We understand when you see stock market prices rising, so you feel tempted to sell. And we cannot expect you to hold for 3 years. Don't sell, hold. It's not practically possible. So that's why for shares there is a concession. Even if you hold for 1 year, you are good boy. Thanks for that. But at least hold for 1 year. See, now I am trying to explain the logic of for some assets 3 years and for shares 1 year. Why? Because see, in general, you can hold the asset for 3 years, hold it and then sell. But shares, you cannot be expected to hold it for 3 years. Why? Because today if I am having shares, every day in the stock market I will see the prices. And the moment the prices rises, I feel tempted to sell. But if government says, no, don't sell, hold for 3 years, that is too much. Yes, if government expects me to hold for 1 year, it's okay. Till 1 year, I can keep patience. But after 1 year, if you sell, government says, no problem, it is long term. But till 1 year, it will have the character of short term. So in short, logic of 1 year, I have explained. Why especially for shares 1 year? Because these items you cannot hold for a longer period. So at least hold for 1 year. But if someone sells within 1 year or for other assets within 3 years, then it will become short. Then you will get a bad treatment. Okay. So tell me how to decide short and long. For general assets 3 years. And for shares it is 1 year. But this was a raw knowledge. This was a raw knowledge. Now here I will give you in detailed manner. It's not always 3 and 1 years. In detail I will explain now. Basically first I wanted to explain in general. In general things are to be held for 3 years. But for shares it is 1 year. Now see, actually the rule is like this. Look, the rule of 1 year is not just for shares. It is for all the listed security. Anything which is listed, whether it is equity shares, preference shares, debentures, bonds, anything. Because see, what was the logic of 1 year? Because item like share, you feel like selling because the moment the prices rise in the stock market, you get tempted to sell. You cannot control. So that thing can happen with any security which is listed. See, listed means what? Listed means the prices comes in stock market. See, if something is listed, stock market will have its prices. So whether it is preference shares or bonds, even debenture if they are listed, every day you can see listed means it is traded in stock market. And the items which are traded, every day prices are revealed. And when the prices are revealed every day, so you get tempted. So that temptation is not just for shares, it can be for debentures or bonds also. That's why see what law says, anything which is listed. You understand the word security? It's a broad term. It just doesn't include shares. It includes debentures, bond, everything which is listed. Because listed item will have daily prices. And everyday prices will make you tempt to sell. So I cannot hold for more than 1 year. And then one more thing. Units of UTI, an equity oriented fund. This equity oriented fund is a mutual fund. What is the exact meaning I will tell you, but this is a mutual fund and this is UTI. So even mutual fund, the rule is what? Hold for 1 year. But wait, what is this equity oriented fund? Look here. Yes, it's a mutual fund which invests in equity. But when it is called equity oriented, look at my example. Assume you are public and I am a mutual fund. So if mutual fund takes the money from public and minimum 65% of that is invested in equity, then it is an equity oriented mutual fund. See, what is the job of mutual fund? To take the money of public and to invest. But where to invest? That decides whether it is equity oriented or debt oriented. So if a mutual fund takes people money and they invest minimum 65% in equity, that means the mutual fund is equity oriented mutual fund. And equity oriented mutual fund, the prices fluctuate a lot. And when the prices fluctuate a lot, your heartbeat also fluctuates. You feel like selling. You cannot hold for 3 years. So that's why government say, okay, at least hold for 1 year and then you sell. See, I'm convincing why 1 year? Because when a mutual fund is equity oriented, its prices will fluctuate a lot. So you will be tempted to sell. So that temptation will come. So I cannot hold for 3 years. So in short, in equity oriented, what you have to remember, minimum 65% the fund will have to invest in equity market. Okay, now see, there is one more thing. Look here. One thing is what I said right now. If mutual fund takes the money from public and invest in equity, how much? Minimum 65%. Then it is equity oriented. Now, there is one more type of mutual fund which is also equity oriented. Yes, see here. One mutual fund will raise money from public and they will give that money to other mutual fund. Means one mutual fund gives money to other mutual fund and they are giving 90% to other mutual fund and that other mutual fund should invest 90% equity. Then equity oriented. See, in short, logic is what when people's money is invested in equity only through one medium, then 65%. But there are double medium. Double medium means it is via. First people will give to mutual fund, then mutual fund gives to some other mutual fund, then other mutual fund invest in equity. So our money goes in equity at a very, means you can say in a very indirect manner. Means first you give to mutual fund, then mutual fund gives to other mutual fund, then the money goes in equity. So I am closely connected with equity or farly connected? Far. So then if it is a far connection, minimum 90% is required. Okay. So these are the definitions of equity oriented fund. You know, this mutual fund is called fund of fund, fund of fund, fund of fund, because that fund is giving to some other fund and then that fund is investing in equity. So this type of fund who gives to other fund is called fund of fund. See, have knowledge, because sometimes in the newspaper they write like this, fund of fund. See, this is not my word, huh? It is a popular word. Many times you will find this written somewhere, fund of fund. So fund of fund means it's a mutual fund who gives to other mutual fund. And that other mutual fund invests in equity. But here it should be 65 or more or 90% or more. 90% or more, then only it is an equity oriented mutual fund. Okay. Anyways, this definition I am giving you as an extra knowledge only for safety purpose. 99.99% in the exam, they will directly mention equity oriented fund. You will not have to decide whether it is an equity mutual fund or non-equity. They will give you only. But at least you should have knowledge of what is an equity oriented fund. See, 90% means logic is what you know. Almost everything should be given to other mutual fund. Like see, if this mutual fund says, I will give only half of the money to other mutual fund, then the chain breaks. Then it will be not equity oriented. Because see, this mutual fund gives only half to other mutual fund. And that half, some portion, from that half, some portion is invested in equity. So people's less money is put in equity. Because see, this 90% is of what? Of the fund which this second mutual fund is getting. So already this is 90 and from 90 further 90. Actually 90 of 90 is what? It's like 81%. So it is diluting further. See here if you keep 65%, what will happen? Here if this is 65%, then from that 65 further 65. 65% of 65 will dilute further. And we want to show equity oriented fund means there is more into equity. And if you directly invest in equity, then 65% itself makes equity oriented. But if it is via, then you know it is getting diluting. Like you know, you are connected with the equity in a distanced manner, not in a close manner. Here there is closeness between people and equity. So 65% is sufficient. But here there is a close connection or not a close connection. It's very far between public and equity. There is a big distance. So here it should be 90. Then only we can say people have invested in equity. See, basically 90 means law wants to say almost everything should be given to other mutual fund. But law cannot be so strict. Give everything to other mutual fund. Just to keep little bit of flexibility, 90% means almost everything you give to other mutual fund. And then other mutual fund should also invest everything in equity. And since this is via, that's why the percentage is big. Okay. So tell me, what are we deciding? When the rule of 1 year is applicable? When? Listed security, units of UTI or units of equity oriented fund. Tell me, what if it is not an equity oriented fund? Means it's a debt oriented fund. Then it will go in others. Then it will be subject to 3 years rule. Because you know, debt oriented funds are stable. And if the fund is stable, the prices are stable, and prices are stable, so I don't get the temptation to sell every now and then. So I can hold for 3 years. But if it is a debt oriented fund, But for equity oriented fund, it is 1 year. And even for UTI, see, actually UTI does the same thing which mutual fund does. Actually, mutual funds are the copycats. Who is the pioneer? Unit Trust of India. Unit Trust of India started this system. Take the money from people, invest in stock market, which is a government entity. And then there are copycats mutual funds. And UTI scheme is always equity oriented. Here I don't have to specify equity oriented, debt oriented. UTI is into equity linked schemes only. Okay. So 1 year is for three things: listed security, units of UTI, and units of equity oriented fund. The rule is 1 year. Then there is 2 years rule for unlisted shares and immovable property. See, for immovable property, you know why government has kept 2 years? Because government wants to encourage real estate investments. Tell me, real estate means what? Immovable property. So see, some years back, finance minister said, we want people should invest in real estate. Because if real estate market becomes stronger, it is good for the country. And to encourage people to invest in real estate, they gave incentive. And what was the incentive? After 2 years only it will become long. Otherwise, other things become long after 3 years. But this will become long after 2 years only. And becoming long is a good thing. It's like, within 2 years only you will get a degree. Long. And degree of long term is a good degree. Why? Concessional tax. In long term, the tax provisions are very good. At least the rate of tax See, there are many other advantages you will observe in long term. But one advantage in terms of rate of tax. In long term, the rates are less. Short term, the rates are high. But immovable property can get the degree of long term within 2 years only. Means after 2 years. But other assets like gold, silver, they will get the degree of long when? After 3 years of struggle. Because government doesn't want to give importance to gold, silver so much as much government wants for immovable property. So in short, especially for immovable property, why 2 years? Just to give importance to real estate in India. Okay. Then, even for unlisted shares, it is 2 years. Tell me why I've written unlisted. Because listed is covered in 1 year, but unlisted, it's 2 years. You know why unlisted shares are not kept in 3 years? Because shares are such item which you cannot hold. See, properties like land, etc., which is an ancestral property. Many times your fathers, forefathers, the property they were holding, till now you are having the property. So those assets can be retained for long and long term. But shares, who feels like keeping forever? Shares are such thing, we want to sell it. So shares government cannot expect you to hold for 3 years. Because shares are, sensitive things. Which a person would never prefer. I will keep shares for ages and ages. I will give to my sons. My son will give to their son. It is not that ancestral kind of property which people want to hold for years and years. That's why for shares, government says expecting people to hold for 3 years will be too much. Hold for 2 years, it's sufficient. And that also if it is listed, 1 year. In short, shares are sensitive things that government doesn't expect you to hold for 3 years. But are you noticing? In unlisted only shares are covered. But in listed, everything is covered. Debentures, bonds, everything. See, once it is listed, whatever it is, 1 year. But if it is unlisted, only for shares it is 2 years. But for other unlisted item like debentures, bonds, blah, 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 it will be 3 years. You are not noticing only. I have written here. It's not I have written casually. I have written thoughtfully. Shares only, it's 2 years. But here I have written shares or security. Security includes everything if it is listed 1 year. But in unlisted only, shares are covered. So conclusion, look here. For 1 year, two things. 2 years, two things. Rest all things, 3 years. So tell me, what about gold, silver, jewelry? Hold for 3 years. After 3 years, you sell long term. And if you sell within 3 years, then short term. Okay. And 2 years is for unlisted shares and immovable property. And 1 year is for listed security, units of UTI and equity oriented mutual fund. What is equity oriented mutual fund? 65% in equity, or if it is via 90%. Okay. That also, see one more point. This mutual fund should invest how much in equity? 65%. That also equity shares of domestic company. Indian companies. See, so much minute thing they don't test. But since I am giving the knowledge, you take the knowledge. Who knows, sometimes the paper is very tough. They can put such questions also. So tell me, 65% should be invested where? Equity shares of Indian company. That means if a mutual fund has invested almost everything in foreign companies, then it will not get the character of equity oriented fund. You know, equity oriented fund is a good degree. It's a good achievement. Why? Because it becomes long term after 1 year only. And after 1 year, long term, and long term is a good thing. Good, less tax. So equity oriented will get the degree of long term after 1 year only. But equity oriented means you should not invest in foreign companies' equity. It should be invested in Indian companies' equity shares. Okay. This was what? How to decide short and long. Tell me, what if it is exact 1, 2 or 3 years short? It should be plus 1 day more. Actually, this calculation should be done cut to cut on day to day basis. Like, see, from the date of purchase up to the date of sale, you have to measure the gap. How to measure this 1, 2, 3? From purchase date to transfer date. If it is exact 1 year or exact 2 or 3 years, then short. If it is 1 day more, long. So, you know, in real life, people do that calculation. Like, for example, if I also have shares, I will keep calculation in mind. When did I buy? And I will see, does 1 year get over? If it is not getting over, I will hold it. Because if I sell within 1 year, it will be short term, the tax will be more. So people keep that track in their mind. And only when the 1 year is complete, they can sell the next day. Because after 1 year, next day you sell, it becomes long. But till 1 and 2 and 3 years which are written, dot 1, 2, 3, it is short. And the calculation is from purchase date to transfer date. It's not from year to year basis. It is date to date, cut to cut basis. Okay. Now, in the recent budget, there was one revolution. 2024. You know, in this budget, what they said? This system of 2, 3 years we are stopping now. Now it is either 1 year or 2 years. Means everything, all other assets have come in 2 years. The concept of 3 years do not exist anymore. So now you will say, sir, then why did you teach us? I had to teach you because budget is effective from 23rd July 24. And if in our exam the capital gain arises before 23rd July, then you have to go as per this rule only. So you have to check the date in the question. Which date? Transfer date. Which date? Transfer date. See, capital gains arises on purchasing something or transferring. So you have to see the transfer date. If the transfer date is before 23rd July 24, then follow this rule. 1 year, 2 year, 3 year. And if the transfer is after, not after, on or after, on or after 23rd July, then the rule is simple. For some item 1 year, for others 2 years. See, 1 year rule remains same for listed security, units of UTI, equity oriented fund, but rest all 2 years. See, this asterisk mark is for what? Just to notify that the system of 3 years is no more applicable now. See what I've written, not applicable if the transfer takes place on or after 23rd July 2024. Okay. Now see, in capital gains chapter, you have to always check the data, because see, if 23rd July, before that, short long is also different, the rates of tax is also different. Tax rate is also different. You forgot, like for general long term, before 23rd July it was 20%, then it became 12.5%. And in that short term under 111A, before 23rd July it was 15%, now it has become 20%. So in short, every time you solve capital gains question, you have to check the date. Which date? Transfer date. See, in the question you will find multiple dates. Which date will be the deciding factor? Transfer date. If it is before, follow the old rule. If it is after, follow the new rule. Now new rule has become simple. Huh? There are only two things, 1 year or 2 year. 1 year for these listed security, blah, blah, blah. Rest everything is governed by 2 years. See, I have explained what is short and what is long. Now see, if short term, how to calculate capital gains. Then if long term, how to calculate capital gains. So now I am explaining the format. So one by one, look. First look at the format of short term gain. Do one thing, look. Don't see this format for the time being. Tell me by common sense, how to calculate capital gains. Gains means what? Profit. And profit is equal to selling price minus cost price. So that is a common sense. Same thing we are doing in this format. See, right now this format looks little bit technical. But once I explain the format, you know what will you feel? Oh, that means it is simple. Selling price minus cost price. It is simple as that only. But law has given the format in a very technical manner. And in exam, you have to show the answer in a technical manner only. But forget the technicality. By common sense, what do you think gain is? Gain is selling price minus cost price. Same thing I am going to do here in the format. So see, I will prove that in this format we are doing sale price minus cost price only. Look, first see what I have written. Can you see the short form FVOC? This means full value of consideration. Repeat, full value of consideration. Feel the word consideration. Consideration means what? Something in return. Like if I sell my gold, jewelry, silver, etc. So in return I will get money. So what I get in return is my consideration. In simple language, it is the sale price. Selling price is the consideration. But see, law is not using the word sale price, because the sale price word suits sale. And capital gains arises not only on sale. There are other transactions also, Sarak 2. See, if law would have written, take sale price, then it is a defective law. On one hand, the law is saying, capital gains is not restricted to sale only. Huh? There are other transactions also. What? Sale, exchange, relinquishment. Remember? Although I have not explained the meaning of relinquishment, but I have told you at least that there are several transactions which can give rise to capital gains. So sale is one of the several transactions. So law cannot use the word sale price. But at the back of the mind, you keep in mind it is sale price only. What? Full value of consideration, nothing but sale price only. One more thing. Why do you call it as full value? Full value means gross sale price. Many times, you know, when you sell a big property, you have to involve an agent. Because big properties, you find it very difficult to sell. You take the help of an estate agent. So agent will charge brokerage commission. So after you pay commission to the agent, you get some less amount in your hand. But what law says? Keep the commission separate. First tell us what you got gross. Full means, read the word, gross amount. Yes, I might argue, but I didn't get the full amount. That agent took 10%. Okay, you deduct it separately in the form of transfer expense. But first you have to show us the full amount. See, like if I sell a property for 1 crore, I might have given 10% to the agent. But 10% agency commission, you write it separately. Where? In the transfer expense. But first government wants to know what was the original price. So I sold the property for 1 crore. So my original price is 1 crore. And that original means full value. Full means the original gross value. That you want to show to government. That government wants to know from you. And then we understand you didn't get the full amount in your pocket. You had to give something to the agent. So you cut it. Where? Here. Less transfer expense. So actually see, transfer expense nothing but commission, brokerage, etc. Other than commission you will not find anything. See, transfer means if you want to transfer a property, what expense you have to incur? You have to hire an agent. So commission will come in transfer expense. So see, in simple language this is selling price. And this is in simple language commission, brokerage, etc. And then after deducting the commission, the net amount which you get in your hand is called net consideration. Can you see NC? NC means net consideration. After cutting the commission, what is the net amount I am getting in my pocket? Okay. See, actually it is selling price only, but why law is afraid to use the word sale price? Because there are lot many transactions. That's why law has to be very professional. So they are not using the word sale price. Student can remember in their mind it is sale price only. But officially when you write, you will write consideration. First full value of consideration, then net consideration. Okay. Now tell me, this is sale price only, correct? First we write gross sale price, then we convert into net sale price. But till now we are at sale price only. Now it's time to compare the sale price with the cost price. Then we get to know the profit. See what I've written on the screen. Okay. From sale price you will deduct cost. But you know cost can be of two types. Kawwa and Kawvi. You know what is Kawwa? COA. Can you read what I've written? COA. I pronounce COA as Kawwa. And I pronounce COI as Kawvi. Full form I will tell you. Kawwa means cost of acquisition. And Kawvi means cost of improvement. And you know why 2 cost? Assume I have got a big property. It is of 2 floors. Originally the property was of 2 floors. Then I constructed one extra floor. So when I construct one extra floor, it increases the size of house. That is improvement. And today when I am selling the entire house. So entire house has got 2 costs. Cost of acquisition, cost of improvement. In my example, when I acquired the property, it was of 2 floors. But on that I constructed one extra floor. So extra floor is improving the house. That's why it is called cost of improvement. And both the costs you have to take. You know why? Because when you sell the property in future, you are not going to sell the part of the house. You are going to sell the entire house. And entire house has got 2 floors and 1 floor. 2 floors is cost of acquisition. And that 1 floor is cost of improvement. In short, cost you have to show in 2 parts. Kawwa and Kawvi. Okay. Kawwa full form is cost of acquisition and Kawvi is COI, cost of improvement. But see, improvement means capital in nature. Huh? Like I gave example of I was having a house of 2 floors, then I constructed one extra floor, then it is improvement, something which should increase the value of the house. If I simply repair the house from inside, that is not improvement. Or revenue expenditure, revenue is not counted in improvement. Don't forget the chapter is capital gains. So expenditure should be capital in nature. So if someone said, no, in the house I did some painting, whitewashing, renovation, these expenses which do not improve the value of the property. They are just revenue expenditure. Such things cannot come in improvement. Anyways, the question is not that complicated where you have to apply your brain. Should I take it as improvement or not? But in real life, these issues happen. Improvement means something which has increased the value of the property, something which is capital in nature. But don't worry, in the exam, they write the word improvement only. They don't even say what he has exactly done. They just write cost of improvement so and so. So you just take it as a cost. So in short, see, look, I will show you this scene once again. This is sale price and this is cost price. So eventually what I proved, the format is sale price minus cost price. But sale price, first you have to show gross, cut the commission, make it net. Then from the sale price you have to deduct the cost. Cost can be of two types, kavva and kavvi. Cost of acquisition and cost of improvement. Always there is no improvement. Huh? Like for example, I have shares. Shares when I purchase, it's the cost of acquisition. What improvement I will do in shares? The bonus shares becomes a different property for me. That's a different property, the cost of which is zero. See, right shares is also a different property. See, when right shares, bonus shares come, they do not become improvement on the same thing. They become a different thing only. See, when I construct extra floor in the house, that house itself is improved. But don't call bonus shares and right shares an improvement. See, if I have got some shares, that shares I will have as it is. Bonus shares is different. Right shares is different. They become a different lot. So don't call bonus and right shares an improvement. In shares, they will not have improvement. Shares at the price which you have purchased is the cost of acquisition. In short, I wanted to say everywhere there is no improvement. But in houses, bungalows, big properties, there are many time improvement. Many people, their original was of 2 floors only. They construct third floor, fourth floor. They make the house bigger and bigger. That things come in improvement. But everywhere improvement is not possible. It is just when we are studying the law, we have to think about all possibility. 90% cases you will not find improvement. In fact, in 90% sums you will not find improvement. But right now we are thinking what if it is there? You should deduct in the cost. See, in your mind what should go on? Sale price minus cost, sale price minus cost. But arrangement, how will you do? Full value of consideration. Means it is a sale price, but without deducting, it's the gross amount. Then transfer expense means commission paid to the agents, etc. Then net consideration. So this is sale price only. Then minus cost, there are two costs. Cost of acquisition, cost of improvement. Kavva and Kavvi. Answer is Satakji. What is Satakji? Short-term capital gains. So this format is done. Next, long-term capital gains. Look at long-term capital gains. What difference you find? The format is almost same. What is the only change? Kavva has become index Kavva and Kavvi has become index Kavvi. Rest all is same. So now what I will have to explain, what is this index Kavva, what is this index Kavvi. What is indexed I will tell you, but it is a bad thing or good thing? Good thing. I have already told you. Long term will be treated in a very good manner. What is this index? See, my plan is what? With this example, I will explain what is index Kavva and what is index Kavvi. Okay? Try this example. Read, there is a land purchased in 2003-4. Cost is 5 lakhs. Tell me, what will you call this cost as? Kavva. See, unless they write improvement, it is cost of acquisition only. So say this is Kavva, say Kavva, Kavva. And this is FVOC. Sale price is full value of consideration, okay? And tell me, this is short or long? Land is immovable property, okay? And for immovable property before budget, the rule was of 2 years. After budget, for every asset, it is 2 years only. So check, is it within 2 years sold or after 2 years? Long after 2 years. So it is long. See, I am convincing long because right now I am explaining long only. So tell me, how will you solve? First, what you will write? First, FEOC, selling price 32 lakhs. Then transfer expense, not given. So ignore it. Every time it's not necessary that there will be some agent who is selling the property for me. Sometimes you are able to directly sell the property. No middleman. So no transfer expense. So directly I am writing the cost. I'm not writing that transfer expense, net consideration, because it's not there only, no? 5 lakhs. Now this minus this should be the capital gains. Now see, generally you compare sale price and cost price to know the profit. But here, because it is long term, look, because it is long term, these which two figures, 32 lakhs and 5 lakhs are not comparable. You know why they are not comparable? Because selling price, look at the selling price. Selling price is modern day selling price, modern day. And cost is very old. See, selling price is new, cost is old. So can you compare people of new generation with people of old generation? No. When your father, mother tells you, we were like this, we were like that, how you say? No, your generation was different. We are millennium. Don't you say it's not comparable? Your time was different, our time is different. So same thing is happening here. Look, the sale price is new generation. Tell me why I'm calling new generation. When did sale happen? 24, now 24, 25. So our sale price is new, Gen Z. It's of new generation. But cost is old. And old because long term means it's a long term old asset. And it's not possible to compare new generation with old generation. You know what happens? Earlier things were cheaper. Now because of inflation, things have become costlier. That's the difference in the generation. See, here we are not talking about our generation, the generation of the market prices. So old generation, things were cheaper. New generation, things are costlier. And you know, when the two things are not comparable, it will not give us the proper profit. So you know what we'll do? If you want to compare this, selling price is new generation. People of new generation will not change. Old generation, they have to change. Why will new generation change? So don't change the sale price because it is new generation. But cost, we will have to tell we will have to tell the cost, dear cost, you are from the old generation. Please change yourself. So when I change the cost to the new generation, it is called indexed cost. Indexed cost means converting the cost of the old generation into the new generation. And how to do the conversion, I will tell you. But we will have to do the conversion. Then only sale price is comparable with the cost price. See, do you understand one thing? When you want to compare two things, the base should be same. Like when can I compare you with me? I know everything, you don't know only. It's not comparable. I cannot compare my performance with your performance. It's not comparable. Yes, within you I can compare. See, he is studying, he is not studying, he is studying, he is not studying. Within you comparison right because you are at same level. Now next what we'll do? Convert this old generation cost into new generation. So for this will help us. Read what I have written. Generation effect. You know, in cost, what is the effect of generation? Old generation things were cheaper. And in the modern times, things have become costly because of inflation. Okay. So these are called cost inflation index. Index means indicator of inflation. Tell me, what do you mean by these numbers? these numbers are given by government. This means a thing which costed 100 in 2001-2, now the cost is 363. This means the cost has reduced or increased. This is inflation. This is inflation. And what do you mean by 105? Something which had cost of 100, next year it became 105, then it became 109, then it became 113. It is constantly increasing or not? That's why it is called inflation index. Now, these numbers which are given, these are not random numbers. These are fixed by Government of India. These are fixed, and these numbers will be given in the exam. Now use this number to convert our old generation into the new generation. Tell me, this 5 lakhs cost, when did you incur? 2003-4. So do one thing, in the year column, please search 2003-4. You found 2003-4? See, I also found. This is the year when I purchased the property. Now look, when I purchased the property, the thing which was 109, it has become 363. So our land was of 5 lakhs. So now it will be of how much? Cross multiply. Tell me, why did I take 109 as the base? Because I incurred my old generation cost in which year? 2003-4. So I have to select 2003-4. And that time if 109 has become today 363. So our cost was 5 lakhs that time. So that will become how much today? Cross multiply. So what is the answer? 5 lakhs into 363 divided by 109. This 1665 is called what? Indexed cost of acquisition. Index cost. Now look, here what I was saying, this cost is of old generation. People of old generation need to change. So see, this will change now. See, I will cross this. This will change and it will become what? 1665, 138. Now, selling price is also of new generation. Cost is also of new generation. Now, new generation is comparable. So, compare 32 lakhs minus 1665, 138. Now, you will come to know the real profit. See, if you deduct 5 lakhs, that's a wrong profit. Because 5 lakhs is cost of old generation. We wanted new generation. So now we can find out the real profit. This is long term. Okay. See, in long term, the word long term means what? The asset is very old. The asset is old, the cost is old, cost is of old generation. So we need to convert the cost into the new generation. And how to do that? By this cross multiplication. See, actually law doesn't say cross multiplication. Look, law has given a formula. You know what is the formula given by law? Look here. This formula is given by the law. See, my style of teaching is different. Nah? I want to explain the logic. That's why I went into this cross multiplication. But in the law, they have not said do cross multiply. Law has given this formula. Read this formula. Cost into index of which year? Transfer year. Tell me, what was the transfer year? 24-25. So what was the index of 24-25? 363. And divide by index of the year of purchase. What was the purchase year? 109 index. See, I have made a song for this. And you will have to remember in a tune only. See, what is the tune? Cost into index upon index, upar transfer, niche purchase. What do you mean by upar? Upar transfer means in the numerator. Upar means up, up. Up in the numerator, transfer year. In the denominator, niche means down, year of purchase. And see, right now you will feel Sir, why there is a need of making a song for this? You are experienced or I am experienced? I am. And I have seen people making blunders in capital gains, and it is all because of the index. See, otherwise, capital gains, the format is very small. Every silly mistake happens in index. So please respect this song. Huh? So how to remember this? Cost into index upon index. Upper transfer, niche purchase. Upper transfer means in the numerator transfer here, and niche below purchase here. Okay. But tell me, this was index kawwa. What happens with kawwa can happen with kawvi also. What is kawvi? Cost of improvement. What example I gave for improvement? What example I gave? Constructing one extra floor. So do one thing. Take that example here, please. Let's assume in 2003-4, I purchased my original house. Actually, in my example, it was land. Now change. Assume it's not a land. It was a house of 2 floors. In which year? 2003-4. And then in 2005-6, I constructed one extra floor. And when you construct one extra floor, it amounts to improvement. So see what I have written near 2005-6. Improvement. And let's assume the improvement cost was 2 lakhs. Again the same. So see, when I did the improvement, at that time the index was 117. And if 117 has become today 363, what will happen to 2 lakhs? Cross multiply, cross multiply. So tell me what will be the answer? 2 lakhs multiplied by 363 divided by 117. In short, it is the same thing. Only thing is when it was kawwa, I took 109 as the base, year of purchase. And when it is kawvi, I took year of improvement as the base. So feel the change in the song. Cost into index upon index, upper transfer, niche improvement. Niche means below, in the denominator, year of improvement will come. See, this will change in the formula. Correct or not? Here below, instead of 109, 117 will come. In short, the formula is same. Only thing is kawwa was incurred in a different year. Kawvi was incurred in a different year. So that base year will change. But the base year will come in the base denominator. So see, both the formulas I have written. Cost into index upon index, upper transfer, niche purchase. That is index kawwa. And what about kawvi? Cost into index upon index, upper transfer, niche year of improvement. Okay. This is called indexed kawwa and indexed kawvi. Tell me, this you do when? In short term you don't do. Huh? Tell me, this is a benefit or a bad thing? Tell me why it is a benefit. Look at this figure and tell me. Because when you do index, your cost becomes big. And that big thing you minus, your answer becomes chota. Tax also becomes chota. Chota means small. So it is a good thing. But that good thing is only for long, for short term, no good thing. See, actually, in short term also, if you sell something in 2 or 3 years, within 2 or 3 years also, there is inflation. But government doesn't give importance. See, technically in short term also, inflation is affecting. See, inflation affects every year. See, this is a proof. Every year price is changing. See the index numbers. Fact that every year the number is changing means every year there is inflation. So if you think from short term also, at least for 2 years the something is short term. So within 2 years also the prices change. But government doesn't want to give the benefit of inflation to short term because government hates short term. Yes, if you are long term, we love you. So we love you to what we will do? We will do indexation that will inflate my cost and bada cost. Big cost when you minus, your gain becomes shorter. In short, this is a benefit. Now see, one shocking news. This concept of indexation is removed in the recent budget. Now you will say, then why did you teach us? I had to teach you. I am helpless because this time's budget came in the middle of the year, precisely on 23rd of July. And our exam question can be from April to March, any day. See, capital gain arises on a day. So what if that day is before 23rd July? Then you follow the indexation system, huh? But if the day of selling the property, etc., is on or after 23rd July, no indexation. Look here. Read what I have written. No indexation if transfer on or after 23rd July 24. Tell me, no indexation is a good news or bad news? See, for a student, it's a good news, huh? Tell me why? Because your working is reduced. Tell me here, if you don't have, look at this example. Here, if you don't have to do the indexation, your time is saved. Then answer is what? 32 minus 5, that's it. For a student, it is good. But for people, it is bad. Why? Because imagine 32 minus pure 5 lakhs, your gain will be big. So, people actually revolted. Why did you stop indexation? But you know what Nirmala Sitharaman said? We have reduced the tax rate also. Be grateful. Earlier long terms were taxed at 20%. Now it is 12.5%. So one bad thing is there. So there is one good thing also. The bad thing is we have removed indexation concept. But the good thing is earlier long term was charged at 20% tax. I am talking about other long term. Huh? Latakji others. Earlier it was taxed at 20%. Now it has become 12.5. So be grateful. Still people are not liking Nirmala Sitharaman. But Nirmala Sitharaman's inner feeling was what, to simplify the law. See, there are people who look at things at a different way. People are there to criticize. See, I might be so good person also. I want to help my student. But a student might take it negatively also. There are different people. So Nirmala Sitharaman's original feeling is what? To simplify the law. And by removing the indexation, the law is simplified. See now, why it is simplified, Now whether it is short term or long term, the format is same. Sale price minus cost price. No headache of indexation. Calculation becomes simple. Yes, long term will get a favorable treatment because the rate of tax is 12.5. Short term will get a bad treatment because the rate of tax is slab rates, etc. But actually she wanted to simplify the law. But people are there to criticize. But they are not bothered. In long run, when the law is simplified, people in future will be happy. Okay. But see, for a student, you should think, to hell with Nirmala Sitharaman's thinking, to hell with public, we are suffering. We have to remember both things. Students are the most suffered people because you have to remember the old law also, new law also. Okay, but can't help. In short, in exam you will check which date. Transfer date, transfer date. See why I am hammering again? Because in the question you will find multiple dates. Which date you will check? Transfer date. Wait, think and answer. Look, if transfer date is before 23rd July and if it is on or after, what changes will happen? 3 changes. Change number 1. If transfer is before budget, rate of tax is different. If transfer is after budget, rate of tax is different. Second point, if transfer is before budget, short, long criteria is different, 1, 2, 3 years, and after budget, 1 and 2 years only. Third difference, if transfer is before budget, indexation. If transfer is after budget, no indexation. This distinction you should write on your notebook somewhere. Tell me the rate of tax before 23rd July. For Satakji under 111A, 15%. See, actually, what is 111A Satakji? I have not yet explained. It is just while explaining the tax rates. I just explained you equity shares short term as a special rate, but that concept is yet to be explained. In this chapter, towards the end, I will discuss about why 111A equity shares has got a special tax rate. But it will come towards the end. And tell me what about Latakji under 112A? This is equity shares long term. And before budget it was 10%. And what is other Latakji? Other than equity shares, jewelry, land, houses, etc. The rate is 20%. But this is before budget. After budget, yes. Satakji under 111A, 20%. Latakji under 112A, 12.5%. Even other Latakji, 12.5%. See, this also to simplify, or what Nirmala Sitharaman felt, even in long term there are two categories, 112A, others. So they have made common rule only. Whether Latakji is 112A or other Latakji, rate has become common now, 12.5%. This is the process of simplification. Next difference. See what I am writing. Period to decide short term, long term. What was the rule before budget? 1 year, 2 year, 3 year. 1 year, 2 year, 3 year. One for listed security units of UTI equity oriented mutual fund. 2 years for fast unlisted shares and immovable property. Rest all 3 years. But that was before budget. After budget, for listed security, all that thing, it is 1 year only. But rest all 2 years. What is the other distinction? Indexation. Before budget, indexation allowed. After budget, indexation not allowed. This is most important. Okay, then look at this. We were going as per this chart. Actually, see, to support this flow chart, look, there are 7 notes. There are 7 notes. I want you to count and check. Look here, I will show on the screen. Note number 1 is to explain what is capital asset. Note 2 is to explain what is transfer. Note 3 is to explain what is short and what is long. Okay. Then note number 4, what is index Kauva? Note 5, what is index Kauve? So 5 notes are done, 2 more notes are remaining. I want to show you here. Look here, note 1, by heart it. Capital asset definition. Look at the screen and by heart. Note 2, definition transfer. Note 3, types of capital gain, short and long. Then note number 4, index Kauva. Note 5, index Kauve. Now note number 6 and 7, and then the basics is over. Then we will start section wise. Okay. Now see what is note number 6. You know, next point to understand, take an example. With example, it will become very smooth to understand. Try this as if you are solving a sum. Try this. Assume someone has purchased a property in 96-97 at a cost of 2 lakhs. 2 lakhs is called what? Kauva. Cost means Kauva, okay. And then it is sold in 24-25 at the sale price of 45 lakhs. Okay, assume 45 lakhs is the sale price. Now tell me, how will you calculate capital gains? For start with the format FVOC, See, I am started. Look here, look. You just keep checking. Am I right? First, you will write full value of consideration. There you will write the sale price. So, what is the sale price? 45 lakhs. Then read what I have written. Transfer expense, what comes here? Commission brokerage, not given. So, net consideration 45 lakhs. Then tell me, assume transfer has taken place before budget. Before budget. So, and it is long term. So, indexation will be done. See this, transfer before budget indexation will be done or not? And why I am thinking about indexation, it is long term. Very long term, very long. See, you purchase in 96, selling in 24. So it's long term. So see, I have done indexation. And how do you sing the song for indexation? Cost into index upon index, upper transfer, niche purchase. So do one thing, what is the cost? 2 lakhs. Give me the index. Give me the index. What is the year of transfer? 24, 25. And what is the index for that? Okay. Now can you see the index? Okay. 363 is the index which will come in the numerator. Okay. See, I have written here. 24, 25 index will be 363. Just check what I am showing. But in the denominator I need index for the year of purchase. And what is the year of purchase? 96, 97. And we don't have the index for 96, 97. You know one thing, look here. These indexes which I am showing here, these are given by the government starting from 2001-2. See, by the way, let me clarify again. Index will be given in the question. Is it clear? And index which are given, law has given from 2001-2. That's the problem in this illustration. See, index is from 2001-2, but I want index of which year? 96, 97. So that is available or not available? Not available. So tell me, should I put a question mark here? Not given by government. This is the way you will solve, not given by government. So what to do? Yes, since we are not having the index for 96, 97, we will have to manage with the oldest indexed. Oldest indexed with us is what? Index of 2001-2. That is 100. So see, I will take here. Look at the screen also, 100. Means, look, I wanted index of 96, 97. But I have to manage with 2001-2. Because there is no other choice. I want rather older than 2001-2. But nothing is given, so we will manage with 2001-2. But see now comes the main thing. See, this even if I would not have explained, you guessed. You already guessed it should be 100. But now see, now what people will argue, if we have to take index of 2001-2, we want cost also to be taken from 2001-2. Actually, we incurred the cost in the year 96, 97. But then we don't have the index. So since government is asking me to manage with 2000. Look, I'll repeat little bit. See, I actually wanted index for 96, 97. But since it is not available, we will manage with index of 2001-2. So see, that is okay. Managing is okay. But what people will argue, why should we manage with 100? Manage means what? It is affecting my pocket. A taxpayer will say what? Is this the way? Manage with 100. I want index of 96. Give us index. And if you are not able to give the index of 96, if you are asking her to take the index of 2001-2, we want the cost also of 2001-2. See, cost of 2001-2 means if the property was acquired in the year 2001-2, what would have been the cost? And in 2001-2, the cost would have been more, because as the time pass, things become costlier and costlier. And costlier means big and big. And if I am allowed to get big deduction, my gain will become chota. See, try to argue with government. See, if government says, no, you take your 2 lakhs only. So government is fooling you. What will you argue? Why should I take 2 lakhs? Are you giving me index of 96? No. Then why should I take the cost of 96? Because cost of 96 will be smaller. See, as you go back in older days, things will become cheaper and cheaper. Because that time the things were very cheap. Now the inflation has made the things costly. So obviously you will say, if you are not giving me the index of 96, why should I take the cost of 96? So that's why government says, okay Baba, we are sorry. Since we are asking you to take the index of 2001-2, you take the cost also from 2001-2. Means assuming if the property was acquired in 2001-2, what would have been the cost? This will be given in the question as fair market value. Means in the question, they will give you the fair market value of the property in 2001-2 is 8 lakhs. This 8 lakhs means what? This 8 lakhs means what? If I would have purchased the property in 2001-2, that time the market value was 8 lakhs. So if the market value was 8 lakhs, I would have incurred cost of 8 lakhs. So 8 lakhs will become my deemed cost. Deemed cost. Actual cost is 2 lakhs. But then where is the actual index? For my actual cost, you are not giving me the actual index. You are deeming the index of 1-2. So I want the deemed cost of 1-2. Okay. And that will be given to you in the question as fair market value. And if I am allowed to take 8 lakhs here, I will feel happy. Why? 8 lakhs is bigger than 2 lakhs. My cost was just 2 lakhs, but now I am allowed to minus 8 lakhs. It's a big amount. So what? Big amount means big deduction. And big deduction will make my profit small. Smaller the profit, smaller the tax. Now I am okay. Otherwise, if government tells me you manage with index of 100 and cost you take that only, then it would be unfair. If index is of 2001-2, I want the cost also from 2001-2, which will be a bigger cost, and bigger cost will give me bigger deduction. Now I will be happy. Conclusion, look, whenever a property is acquired before 2001-2, index is not available, so manage with 100, and since you have to manage with 100, ignore the cost also of 96, 97, take the cost from 2001-2, and 2001-2 cost means it will be given in the question as FMV. Okay, now tell me, right now in my example, taking FMV 8 lakhs, you are feeling happy. Why happy? Because it is a big amount, na? Compared to 2 lakhs, it's a big amount. Now, imagine, what if it is like this? See the change in example. 12 lakhs. Means imagine, my actual cost was 12 lakhs. And the FMV became 8 lakhs. Firstly, is it possible? Generally not possible. Why? Because as the time passes, things become costlier and costlier and costlier. And see, 2001-2 is old time or the new time. It's not a means compared to 96. It's not older time. It's a new time. And as you go ahead, the cost should increase. So see, if the cost itself is 12 lakhs, FMV cannot be 8 lakhs. Practically, it will not happen that prices are falling down. But in shares, anything is possible. You know, even shares is a candidate of capital gain. And in share market, anything is possible. View this as like a shares. Imagine someone purchased the shares in 96 for 12 lakhs and the market price fell down to, it is possible or not? So in shares this is possible. So tell me if it is possible, now if government says ignore 96, take 8 lakhs, will you be happy? Now you will feel sad. Why 8 lakhs? When I have incurred 12 lakhs. I want my 12 lakhs. Why are you dying for 12 lakhs? It is big amount, it will give me big deduction. But government says, no, 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 forget. Index is of 2001. Price will be also of 2001. Forget those days. Now you will not accept. So in such case, people will further argue. So that's why government says, okay, if you feel your real cost was much higher, take that only. In short, you can take whichever is higher. Finally, government has left on you. You take what you want. If you feel your actual cost was higher, take that. And if you feel your actual cost was small and FMV is big, take FMV. So see the presentation. Look here. I'll do one thing. I will change my example to 2 lakhs again. Huh? So tell me, between 2 and 8 lakhs, which figure you like? 8 lakhs. Whichever is higher. See, why do you like whichever is higher? Because if your deduction is more, your profit will be less, tax will be less. And you know, this kind of presentation you will have to show in exam. By heart the presentation. When you are solving this sum, how will you solve? Show actual cost and FMV both and show this arrow to indicate whichever is higher. And the one which you select, put it in box. Okay. And then tell me what will be the answer? 8 lakhs into 363 upon 100. So see, conclusion is what? Whenever purchase is before 1st April 2001. See, even in 2001, what is the first date? 1st April. So whenever purchase is before 1st April 2001, either you can take the actual cost, which was 2 lakhs in my example, or you take the FMV, which was 8 lakhs in my example. You can take anything which is higher. Okay. You know why this problem is happening? Because index is not given by the government of years before 2001-2. Okay, see, can you see one asterisk mark here? See, by comparing actual cost and FMV, you will take what? The one which is higher. But there is one exception here. If it is an immovable property, then you will have to take stamp duty value or fair market value, the one which is lower. Means either FMV or stamp duty value. Out of the two, whichever is lower. And that lower thing compare with actual cost, whichever is higher. You know why? Because see, for immovable property, the importance is of stamp duty value. You know what is stamp duty value? Actually, it's a fair market value only, but as per the opinion of stamp duty department. You know, in every state, Maharashtra, Gujarat, Telangana, every state there is a stamp duty department, and that department has got its own market values, and that is called stamp duty value. So, in case of immovable property, which properties? Immovable property. If stamp duty value is given, actually you should take that only. But if FMV is lower, then take FMV. Actually, government wants to give you as low as possible. Because already government is asking you to take whichever is high. But now in FMV and SDV confusion, you take the lower one. Because government says already we are giving you the option of whichever is higher. Now in FMV and SDV, if there is a difference in the values, see actually technically speaking within FMV and SDV, there should be no difference. Because FMV is market value, even stamp duty value is market value. But there is difference in real life. Why? Because SDV is ascertained by the stamp valuation department. And if FMV is found by a different department, they have a different figure. And when I say FMV, it is determined by income tax officer. And see, if there are two people having different opinion, the figures might differentiate. Like if I tell you, okay, Bala, you find out in the market what is the property price in Hyderabad. And then I say, Divija, you find out in the market. So if two people go for a survey, they will have a different view. Because market is big. So actually FMV, SDV, technically they are same. But since SDV is as per the opinion of stamp valuation department, it is sometimes a different figure. And FMV is as per the opinion of income tax officer. So that income tax officer might have a different view. So that's why there is difference. So which figure to take? Lower one. Okay, means here government doesn't want to give you more benefit, because if lower one is taken, you will get lower deduction. So that's why government said take lower one. See here I have written. In case of immovable property, which one you will take? FMV and SDV, whichever is lower. But then don't forget to compare with actual cost. Because when you compare with actual cost, you can take whichever is higher. But between FMV and SDV, you have to take the one which is lower. Okay, now look here. Tell me here why this theory started, what was the main root cause? We are not having index. That was the problem. But see, this is purchased before 2001-2. What if improvement happens before 2001-2? Look here, even in improvement, you need index. And the problem is what I am discussing is index is not available of the years before 2001-2. So index even improvement needs. See in the formula, don't you need index for improvement? So now tell me what if improvement happens before 2001-2? See in this example what happened? Improvement happened before or purchase? Purchase. Now my next theory will be, what if improvement happens before? Purchase before 2001 is done. Next is what if improvement before 2001? So see, the rule is very simple. If improvement is before 1/4/2001, ignore it. Government has bluntly said, ignore it. Why? I will convince. Rule is very simple, ignore it. Many people buy it only. Okay, we should ignore. If in the question improvement is before 1/4/2001, ignore. We will ignore. But why? So see, to convince, one small example is ready. In this example, you will find it very convincing. Convincing about what? Why are we ignoring improvement? Okay, see my example. See, I want to create an example of improvement before. So check, I have done that only. See, improvement is in 98, 99. Means it is before or not? Okay, now understand the full story. Huh? There was one guy. He purchased the property in 96, 97 at a cost of 5 lakhs. And see, when he purchased the property looked like this. Can you see the drawing of the property? It looked like that. Then in 98, 99, he constructed one extra floor. So the property looked like this. Did you see the looks of the property? Earlier the property was chota. Chota means small. Then it has become mota, means it has become big. Why? Because you constructed extra floor. So that is improvement. And what amount I had paid for improvement? 1 lakh. And then I have given FMV. Why I have given FMV? For this formula. See, if improvement is before, purchase is also before. Purchase will be much before. And for purchase before we need FMV. So I have given FMV. Okay, now let us solve this. Okay, solve. Check till here. Is it correct? I am assuming the property was sold for 45 lakhs. Okay. So check the calculation. FEOC 45 lakhs. Net consideration 45 lakhs. Now what will you write? Kawwa or index kawwa? Index because it is long term. It is long term. And I am assuming the transfer has taken place before budget. Are you noticing what I am saying? Because after budget there is no headache of indexation. But I am assuming before budget. So tell me what will you do? Cost into index upon index ऊपर transfer नीचे purchase. But you know cost will be taken either this or this, whichever is higher. See what I have written here. Whichever is higher. So what is higher? 8 lakhs. So see I have shown here. You just check have I done it properly or not. 5 lakhs and 8 lakhs. 5 and 8. What is high? 8. So see I have circled 8. Into index 363. Upon index I have taken 100. Why? Because index of 96 is not available. So we have to manage with 100. Till here it is okay. Now after this for improvement see what I have done. Ignore. Why? See my improvement is of 1 lakh. But government says no need to deduct improvement. Straight no. Ignore. Why? First tell me, are you feeling bad when government says ignore, ignore? See, try to think like an assessee. See, why should you feel bad? Because see, when you incur cost, you are allowed to minus. And you love minus. Because minus will become, it will reduce my income, it will reduce my tax. But government says to hell with your improvement. We will not allow you to minus. It feels bad. But you know, you should not feel bad. Because instead of feeling bad, be grateful. Already you have taken FMV in the deduction. Look here. This FMV of 8 lakhs, it is automatically with improvement. See this 8 lakhs you deducted here. Say yes or no. Yes. So that 8 lakhs is what? It is market value before improvement or after? After. And see after improvement, my house was small or big? So the FMV of 8 lakhs, it is already including improvement. See, here with the help of drawing you understand. When you minus index kawwa, you have deducted small house or big house. In index kawwa, you have deducted small house or big house. Big, because you have deducted 8 lakhs. And 8 lakhs is a value after improvement is done. So improvement is already included in the FMV and that you already deducted. Now you want to deduct once again? Never allowed. That's why government says ignore. See, we feel bad when you have to ignore it. But then you should also realize that within 5 lakhs and 8 lakhs, which figure you selected? 8 lakhs. And 8 lakhs is a figure after improvement. It includes improvement. See, if improvement was not there, my market value would have been less. Because improvement was done earlier. In the market, the value came little big. So market value is including improvement. That's why you have to ignore it. Okay. See, I'm putting a cross mark here means improvement is to be ignored. Wait. See, right now the way I'm convincing, it looks convincing. But you know what doubt you will get? Sir, in this actual cost and FMV, we take whichever is higher. Yes, what if this figure is higher? See, I'm making one change, huh? See, I'm making one change. Look here. What if this is 15 lakhs? Did you notice the change? I have made actual cost as 15 lakhs. So now tell me, in actual cost and FMV, which one is higher? 15 lakhs. So we will select this, and this is house with the improvement or without improvement? Without improvement. That means you deducted a house without improvement. Now what about improvement? Still not allowed. Still not allowed. Why? See, when I selected, I'll give you the reason, dear. Listen, when I selected 8 lakhs, everyone was yes, 8 lakhs is after improvement is done. So it includes improvement. But now it is not necessary that you will select 8 lakhs only. Government has given me the option of whichever is higher. So what if this actual cost is higher? That is the original cost when the house was small. That doesn't have improvement. But still government says no. You know why? Because see, this change of example which I did, what change I did? I made the cost as 15 lakhs and I kept FMV smaller. This is practically impossible. Impossible. See, with my marker, I can do anything and change. But it should happen in real life. Practically, you know, this FMV will always be higher than actual cost. Accept this, otherwise I will not proceed. I know you will not accept. But listen to my statement. This FMV will always be higher. So now what counter argument you will have? Sir, how it can be higher? You only said in stock market, anything can happen. Means thing which was 15 lakhs in past, market value became 8 lakhs. In share market, you said prices come up and down, up and down. But in shares, there is no improvement. Nah. In shares, there is no improvement. Generally, improvement happens in houses, in properties. Their improvement takes place. And generally, in properties, the market price increases only. And forget, even if there is no inflation. Look, even if there is no inflation, imagine a property on which one extra floor has come, that itself will increase the value of the property. See, because of inflation, the price will increase. But forget, even if there is no inflation, even if there is no inflation, a property which was chota, which was small, on that if I construct one extra floor, the size itself has increased. Market value will become big only. In short, we have got full confidence that this market value will be always big, especially in a property which has been subjected to improvement. So after improvement, the property value will automatically rise. So that means I am proving what? Always FMV will be higher. And when FMV will be higher, it includes improvement. That's why no separate deduction for improvement. Conclusion is simple, but it was all about convincing. Okay, now tell me, what if this happens? Look, some more drawing here. One more floor I have constructed in the year 5, 6. Are you seeing the change of my house? My house was chota. Chota means small. One floor came. One more floor came. The red floor was before 2001. Ignore. And the blue floor. Blue floor is newly built in 2005-6. So tell me what about this improvement? Ignore or deduct. This you will consider. Can you say, no, even this improvement is included in FMV? That's not possible. See, FMV is of 2001-2. So improvements done before automatically included. But improvement done later on, it is a separate item. You have to separately minus. Conclusion. Improvement, always check the date. If it is before 1/4/2001, ignore it. If it is after, consider it. Consider means minus it. And when you minus, you have to sing a song. Cost into index upon index, upper transfer, niche improvement. But this deduction will be done only when the improvement is afterwards. Before improvement is to be ignored only. This is when the improvement is done afterwards. Okay. Finally, you know what we have done? Basics are done. Basics are done. In that there were 7 notes. Okay. Now after this, look. After this, section wise study will start. What? Section wise study. Section 45 1 to 55. Okay.